Good evening, everybody, and welcome to the Library Mistakes. Most of you are regulars, but not everybody. So we are a free public library dedicated to the study of business and financial history. We're open 9 to 5, Monday to Saturday. And if you haven't already registered, please register. And you'll get invites to these events, and you don't have to be there to watch them because this is being live streamed. And it is also recorded, so lots of our old lectures are up there as well. This library also runs a course in finance, which is running today, because I know I've just been teaching it in London, and I've got here just in time. I can report that the course is full, and the lights will be over for another year. So we all wait with bated breath to sell the course, so that's good news. I'm delighted tonight to introduce Eoin McLaughlin from Heriot-Watt University, who's going to talk about something which is actually remarkably important. I must say I hadn't heard of this particular incident of 1956, but it relates to the monetary standard, which may be an option that Scotland might want to consider should the people vote for independence. It is something that currently runs in Hong Kong, so it's exceptionally important in terms of the relationship between Hong Kong, China, and the rest of the world. We'll come back to why there's something quite peculiar happening in Hong Kong at the minute, which is not dissimilar to what Owen's going to talk about. So this is my favourite subject, which is monetary history and monetary theory. And now we're going to talk about something I know absolutely nothing about.
Oh,
Owen.
Okay,
Please,
thanks very much. My starting point, I just asked ChatGPT, what is Ireland's economic model? Like literally, these are the prompts. And it said, like, what about, you know, if you asked the man on the street, what would you think it is? Below corporation tax, FDI. And then, when did Ireland introduce below corporation tax? I keep an eye on time. And it said 1956, that's right. And then why did it do it? And it said, well, it's low economic growth, it's depression, blah, 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 crisis level. And then I asked the latest one today when I was coming in, and the new answer was it got inspired by a report in 1958. So I said, well, how could the report written in 1958 cause, like, so it's all, so the AI doesn't know because it's basically what's in the training data. So that's kind of starting point. And then I've been talking about this stuff, the British disease, right? The British disease is really important. And there's a great book, because I asked, like, do you have anything by Sidney Pollard? So Sidney Pollard is a brilliant, he was a brilliant economic historian, but he wrote this book, The Wasting of the British Economy, and this is another book called The British Disease. So the British disease is really an important part of this story. It's basically Britain's relative decline. It goes from being the richest country in the world to one of the worst performing countries, and it happens after 1950. So this is the context for this. I call this the British disease 1.0 because we're back in a British disease right now. This is British disease 2.0. British disease is low investment, low productivity, high wages, just a stagnant economy, right? So this is the British disease. So this is a graph based on Nick Kraft's book, Deindustrialization, Is It Bad for Your Wealth? And Nick Kraft is trying to say, well, Britain's doing all right because it's shifted into a service economy. But there was one period where Britain did really badly, and where basically all of Europe caught up with Britain and overtook Britain. And that was the period of 1950 to 73. That's the golden age for European economic growth. The worst country, well, obviously Britain's one of the worst, Ireland. It stands out here, right? So Ireland in the golden age does even worse than Britain. So that's telling in itself. And then if I just include every single country, you know, it's even doing worse than Portugal, which is pretty bad, right? So this is just from the 1950s. So something's gone on in the 1950s. Now this is GDP per capita. This is before Ireland had leprechaun economics, right? So you can trust these numbers. You wouldn't trust them today, right? And then Ireland and Britain, they're moving together, and it's a bad thing then to be tied to one of the worst performing economies. So, like, if you're tying yourself to the worst performing economy in Europe, you're not going to be doing very well. So, Ireland's not doing very well. This is again GDP per capita, and in 1950s Britain, And Ireland is about stop-go economics, right? So stop-go means you have a boom, people start to import more, then you have to pay for your imports. So then you have a problem, and then there's a sudden stop. Stop-go, stop-go. That was basically Britain's economic history from 1950 to 1970s. Ireland didn't stop-go as well because it's tied to Britain. This is the whole point of this, how it's tied. But there's a difference. This is GDP per capita and GDP. The kind of bold line here is GDP. And GDP per capita for Ireland is higher than its GDP. That's unusual. For Britain, it's lower. And what Ireland has figured out is if people leave, your per capita goes up, right? So if you have an immigration outflow, your GDP per capita will grow. So you can grow the economy by shrinking the population. And that's what happens, right? So this is 1950 stop-go from population. I have the expert on Irish immigration right there, so he can correct me for my mistakes. But basically, we have a really bad year. 1956, Irish Times says one of the worst years the Irish state has experienced, right? So this is a book from Tom Garvin, and it was like he was going through a newspaper report. And then these are passenger flows. So where are people going? When are they leaving? And it's been an uptick from the 50s, but a big uptick to Irish immigration in America. And it's caused by this crisis, right? So there's a really bad crisis in the 1950s. That's what we want to try and get to. So there's a quote here from Mary Daly's recent book, and it's just talking about the impact of this. She was calling it depression. It was so bad in the 1950s. Led to mass immigration, huge crisis, etc. The government at the time, they lost the election, took them ages to get back into government. People remembered this, damaged the career of this guy, Gerard Sweetman. And what's at the heart of this is basically chronic balance of payments episodes, right? So balance of payments, if you don't know, that's when you're importing more than you're exporting. You don't have the ability to pay for your imports. Ireland and the UK, I tried to do a comparison of the two as much as possible. And so UK has a balance payments crisis in 52, and it has one in 55, but Ireland's are worse. The 52 one doesn't seem to have a kind of lasting effect, whereas the 55 one is...
I think that's what's going on. So let's just move it up there. Because that would be better.
Yeah. So the question we have, and if I go back and do this kind of study again, so this is, I should have said at the start, this is a study with Sean Kenny from the University of London and with Eoin McLaughlin, who's at the University of Cambridge. If we were going back, we'd look at this 52 episode and see what was so different about 52. But this is kind of giving us some of the answer. These are the external reserves of the country. And the external reserves are basically the reserves of the banking system. So the Irish banking system used to be part of the UK banking system. And for all extensive purposes, it never changed after independence. And basically then, Irish reserves are in London. So the commercial banks have reserves. The Central Bank of Ireland, which is a currency board at this time, gets converted into a central bank. It doesn't have as much reserves as the commercial banks. It doesn't even have that much gold. So it's what's happening with the commercial banks is the really interesting thing here. So what caused this crisis? So this is an authoritative account by Kennedy and Dowling. And they look at the deficit on the current account. What was causing it? Big increase in imports and a decline in exports. That's what you'd expect. So the net capital outflow and external reserves, they fall by 47 million. Why is this important? Well, you're going to tell me why it's important today. But for Ireland, this is basically when the switch goes on. This is when everything changes, because this is the introduction of low corporation tax. Low corporation tax is the solution to this problem. And it starts out as export profits tax relief. That's where it starts. So this is the birth of modern Ireland. I don't know if you'll and will agree with me or not. But this, for me, is where it all starts. And it's this policy change. And it's because of this balance of payments crisis. And then it gets fed into this famous report called Economic Development, written by T.K. Whitaker and others. And one of their main motivations, they say, look, our wartime accumulation of sterling reserves has been run down. Our wartime dollar borrowings have been spent, but our balance of payments remains unstable. And there was only 1 year since 1946 where they didn't have a deficit. And that was not secure, they said, right? So the balance of payments is one of the most important things here. And getting out of this crisis basically sets up modern Ireland. But then we don't really know what caused it to begin with. This is a weird thing, because we're kind of in two worlds here of modern economics and economic history. Because modern economists from like the 60s and 70s, they don't really look back at the past. And in Ireland, the Irish economists don't really study the past. The economic historians don't study the present. So you're at this weird, basically, phase where we're not really sure. So we've got two accounts, and I'm giving them both equal weighting. So Dowling and Kennedy, Kieran Kennedy, you know, he studied under Kuznets, who's a Nobel Prize-winning economist. He's no joke, right? So he knows what he's doing. Honohan, Patrick Honohan, Cormac McGrath, two really heavyweights in Irish economics. Honohan was the governor of a central bank. Basically, they come up with alternative conclusions. The first one says it's driven by fiscal policy. Basically, the Irish government, increased spending. It's expansionary fiscal policy. It's causing this crisis. You know, this leads to a rise in imports. The second one says it's a monetary experiment. It's attempting to operate independent monetary policy in a fixed exchange rate regime. And I'll explain what these things mean in a second. So for this particular study, it's a paper we've written and that we're working on, but we're basically looking at this big shock to the Irish economy. We're looking at it through the lens of very high frequency data for the time period. So it's daily data from the Dublin and London stock exchanges, looking at bond portfolios of banks and then banking indices. The methodology is basically how we did it and what we see. And we're basically trying to see, like, well, what caused the balance of payments crisis? And we're leaning towards this monetary policy driven, but not for the reasons that originally thought. So what is this? If you're familiar with your macroeconomics, this is the impossible trinity, right? You can't have all of these three things at the same time. You can't have perfect capital mobility. You can't have a fixed exchange rate. And you can't operate independent monetary policy at the same time. You have to pick a side of this. So like modern day, the US has free capital mobility and an independent floating exchange rate, and it operates independent monetary policy. China restricts capital mobility, has a fixed exchange rate, and has independent monetary policy. Ireland currently has a fixed exchange rate and free capital mobility because it's in the euro. But back then, it effectively had a fixed exchange rate and limited capital mobility, so some monetary autonomy. And that's what we're going to explore. And the thing is, at the time, no one knew this. This was a new idea at the time, right? So this is written, the first paper, Robert Mundell's optimal currency area. I've tormented students for years teaching this stuff. But basically, it comes out in 1961. So they don't know about this stuff. And a history of economic thought would say, well, maybe people knew about it in the 50s if you read between the lines of what James Meade was saying about balance of payments. I don't think policymakers are reading between the lines of what James Meade is saying, right? So no one really knew what this was about, but people were trying different things. And in Mundell's paper, he said Canada was one of the only countries he knew which was doing an experiment at this time. Canada had tried to use a flexible exchange rate with the United States. Canada's exporting timber to the United States using a flexible exchange rate. He doesn't mention Ireland, but Ireland fits in with this. It's another experiment. And this is where ChatGPT strikes again. It's I asked it just to do a picture of the trilemma. It gives me a really dodgy map of Ireland. Like if you zoom in on some of the place names, I think this one down here is Londonderry, but Londonderry, yeah. But for somehow it thinks this is a great example of a trilemma. So yeah, maybe it is. Maybe it is. Okay, so for the trilemma, we have different views of fixed exchange rates. You've got the traditional view of Mundell versus Goodhart. Ireland here is a bit different, and it's kind of unique because it has free capital mobility within the UK. Effectively, it's treated as though it never left the UK by the UK government. It has this fixed exchange rate with sterling, which it's operated for almost 100 years or more at this point. And it had previously always just followed whatever the Bank of England did. So UK monetary policy, if Bank of England raised rates, it would raise rates. If it lowered rates, lowered them, right? The counterfactual to this would be, well, what if they did things differently? What if it was like today and you just had a flexible exchange rate? Could Ireland have had an independent monetary policy back then? Right? Could have just done whatever it wanted, but had a flexible exchange rate. And this is where the modern theory is kind of really helpful, because this is about, rather than having a trilemma, it's a dilemma. And the argument from Ray and others, basically, whatever the hegemon does, you should follow what the hegemon does, right? So if the hegemon increases interest rates, you should do the same thing, because otherwise your capital will flow to the hegemon. So you should do it, irregardless. And the paper for looking at the relationship between Ireland and UK, there's a really close relationship between the two. You know, the business cycles are almost synchronous, similar inflation. So you should do what Britain does. So I know I'm doing really badly with time, but I'll try and get through as much of this as possible, just to explain where Ireland fits in or what's going on here, right? So Ireland was in a monetary union, a complete monetary union, and then it creates an incomplete monetary union. And incomplete monetary unions are fragile by design because you don't have these parameters. Before Ireland became independent, there was a common central bank, which is effectively the Bank of England. There was a fiscal union with the rest of the United Kingdom. There was a political union. There was a banking union, but there wasn't symmetry. So for classic optimal currency area, you either have symmetry or you have flexibility. And there was flexibility, a lot of it, because of labour mobility between two countries. There wasn't a separate currency before 1927, but there was after 1928. And when you have a separate currency, you can leave a monetary union whenever you want. So exit becomes very easy because you print your own money. So that's the distinction between the two periods. The really interesting thing is the banking system. So the banking system predates independence, and it operates on an island-wide basis. So it's not just in the south of the island, in the Republic, and it's not in the north. Some of them operate in both places. And some of them had the right to issue notes before 1920, and some of them have the rights to issue notes in the south, and then some of them have the rights to issue notes in the north. And then you have some grey area where you're not allowed to operate in the north, issue notes, right? And that's just the kind of thing we exploit in the paper, because it makes a difference in the banking system, because the notes are really easy to convert from one country to the next. The border is very easy to get across. No one's really checking. And just to show you what the notes look like, this is the same bank, Bank of Ireland. Headquarters traditionally was in Dublin, but then they opened a second headquarters in Belfast. Same bank issues different notes in different jurisdictions. So the Bank of Ireland has this note in the south, Currency Commission note issue, and in the north it can issue its own notes, kind of like in Scotland where most banks have their own right of issue. Ulster Bank is similar. Ulster Bank has notes in the south, and then it has notes in the north. This is just to try and explain like what we're doing, just and looking at banknotes is always fun. Then I think so. Yeah, pardon? No, it's the same. It's pounds a pound. Yeah. Yeah, they're printing pounds in Belfast. They're technically going to be called punts in the south, but they're still pounds. Pounds a pound. You can trade them in both places. This is the nice thing about this. Yeah. Yeah, with the peg, it's worth the same. So Munster and Leinster, they don't operate in the north. This is one of the banks we use for for identification in the empirical analysis. Provincial bank, this is one of the older ones, so it has a south and north, etc. Then we have a currency commission, currency board, which changes its name to a central bank, but it's still a currency board in all but name, right? And they have these notes. So this is a currency commission note, legal tender, £50 note. Zoom in, and it says, it's in Irish and in English, but in the English one it says £50 sterling payable to the bearer on demand in London. This is issued in Ireland, but it's payable on demand in London. That's the nice thing about this thing here. And then traditionally, so the blue line is the UK rate, so the bank rate, and the green line is the Irish rate. Traditionally, the Irish rate would always be above the British rate. This would make sense because if Irish rates were lower, well then funds would go to England. So you always have to have a higher rate to retain capital in Ireland, basically. Apart from this period here where things get weird, I do have a footnote. Basically, there's a change in the series. There's a different series. Before, it was based on what the banks said the rate was, and then it was changed to what the central bank said the rate was. We'll explain what that means and if there is anything to go by. But there was an informal rule that the banks in Ireland had, and this was the Irish interest rate rule. And it said, based on historical experience, it moves at 1% above the Bank of England rate when the latter is below 5.5%, and 1.5% above the bank rate when the bank rate is at 5.5 and above. So that was the old rule of thumb. You always had your rates above the bank rate. The only other time in Irish history that this happened was 1836. And in 1836, Bank of England didn't communicate to the Bank of Ireland that it had raised rates, led to a financial crisis in Ireland. So similar thing as this, but it's not as documented. So the Irish rates we have here, we have the Bank of England rate, which is gradually being risen, goes up in steps. We have an Irish rate, which is the spread of the bank rate. We have the Central Bank of Ireland rate, and then an Irish bank rate if this rule was followed in the 50s. Because the rule, as you can see, the rule doesn't follow in the 50s anymore. And then this is just a deviation. And so there is some implicit understanding that things are different in Ireland. They don't have to follow this old rule anymore. But the tolerance for deviation from the old rule is at about 1.5%. And then once the official rate goes below the bank rate, things get difficult. So the traditional analysis is this is an Irish problem. They didn't follow rate rises in Britain, and it led to a balance of payments crisis. But this is where I think this becomes much more interesting and tells us more about Britain than it does about Ireland. So I think Irish history here is more informative of what's gone wrong in Britain than what's gone wrong in Ireland, right? So the British context here is basically sterling is in decline. Sterling is no longer a reserve currency at this point. The Bretton Woods Conference basically ends sterling as reserve currency. It's the dollar. This is a dollar world. And after World War II, the exchange rate was set at 4. So this is what a fixed exchange rate would look like. You keep your exchange rate at 4, but it suddenly drops to 2.8. So it's this devaluation. Once you devalue a currency, there's always the anticipation that you'll do it again. The credibility that you have is gone, right? So the dollar is now the hegemon. Britain is devalued. This is a big devaluation by the Times, one of the highest. And so there's always going to be this, well, when are they going to do it again? It's not a question of if, it's when are they going to do it again? They did it again in 1967. And then there is a devaluation, implicit devaluation in 1973, which I'll get to at the end. But basically, this is the backstory here. So sterling has become very weak. And what's happening in 1955, now this graph here is just the daily exchange rate for sterling. Within the Bretton Woods system, you could only go 1% above or below the official rate. So 2.8 was the official rate. So this only goes from 277 to 281. But this matters a lot. You wouldn't think it looking at this figure, but it does matter. So you have these rumors, and the rumors start in Switzerland, right? Because the Swiss have convertibility, and they're saying, oh, I think sterling is going to devalue. So British policymakers are trying to defend the pound. That's what they're doing. That's what their focus. So it's an international story. It's speculation what's going on. The other interesting event in British history in the 50s is the Suez Crisis. And in Suez, the Americans used this pressure on the pound to get Britain to do what it wants, right? So if you don't withdraw, we'll put pressure on the pound, hit Britain where it hurts. This is different, and this is actually worse than 1956, which is kind of interesting. So what's happening here? Basically, the Bank of England is very cautious. It doesn't want to tell anyone what it's doing. And what it's doing in America, instead of going to the Federal Reserve, it goes to the Bank of Canada's office in New York and asks the Bank of Canada to do trades for it. So it's very cautious, very secretive, because it doesn't want people to know that it's propping up a weak currency. It doesn't want the markets to know this. But people know. So this is the bands, right? The 1% and -1. There's a lot of pressure because people think something is happening in 1955, and they think the British government is on the verge of another devaluation. So Bank of England is active in these years in the foreign exchange market, but it doesn't want anyone to know it's active. It doesn't want the public to know. It doesn't want anyone to know. So it's very reluctant to share information. So when the Federal Reserve phones it up, they give these cryptic answers to the Federal Reserve. It might be in the range. That's the kind of answer they give. They don't give a full answer. So they're very reluctant to cooperate with the Federal Reserve. There's no cooperation with any authorities in Ireland. So Ireland doesn't know this is the real reason things are operating as they do in Britain. It's only from the 1960s that Britain becomes more cooperative with the Fed. So we normally think the history of the 1950s and the Bretton Woods period that central banks are cooperating. They're not. Bank of England is purposely not cooperating because it's afraid what will happen. And the reason they start to cooperate from the 60s because there's almost continuous crisis for sterling, and they need the help of the Federal Reserve. So where does this fit into my story here? So this is Rab Butler. He was the Chancellor. And I found this really nice discussion in Hansard. But basically he's talking about the exchange rate. And he says members will smile that the sterling dollar rate has risen from about $2.78 in the third week of February to just over $2.7958. And the rate for, whatever. But anyway, the last bit is, this is a very considerable rise, right? It's only 1%, but it doesn't matter. This is a big deal, right? And one of the things that's going on is the UK's balance of payments, right? So this affects the terms of trade. This is going to affect inflation in Britain. So this is the reason why we're taking action. And I said, and from this result, all I can say is thank goodness that we took action in time. So they're very aware of what's happening, and they're very glad that they took steps to resolve this issue in 1955. But there's still these rumors of devaluation, and they don't get quashed until it's officially discussed in House of Commons. So this is Edward Boyle. He's Economic Secretary to the Treasury, and he said, there have been certain rumors recently about the possibility of some kind of devaluation, and I can only say quite categorically that there's no such intention. They're not going to devalue, and that's pretty much the end of the run on sterling in 1955. Here we come into Ireland, right? So Ireland doesn't know this is happening in the background, so it's basically hidden from everybody. It's coming into this, basically, it was burned pretty badly in the last British devaluation. 1949 devaluation, it held 5% of sterling liabilities. It saw its external debt to the US rise by 44% because of the devaluation. A representative from the Irish Treasury had been in London the week before, had meetings with Bank of England, and he was told, whatever you do, don't sell your sterling, it'll be fine. And yeah, there was a devaluation, and so people weren't very happy. They're seeing this stop-go happening, everything basically being imported for Britain, and they want to see if they can change things. So this is where the experiment that I want to look at comes in. So this is the Minister for Finance. He said he has... So this is coming from finance, right? So this is an era where there's no independent monetary policy, so it comes from finance. So the Minister for Finance has decided that they're going to experiment with monetary policy. So I've had discussions with representatives of the Irish Bank's Standing Committee on the implications of recent change in the bank rating in Britain. I represented to the banks that the conditions underlying the increase in Britain do not operate here at present. And recognising this, the banks have, in the national interest, decided not to make any change in their lending rates here. I should like to express my appreciation of this decision. So basically he goes and tries to get the banks not to match the rate raise. It's not that simple. The banks basically have three different rates. They have a London rate, they have a Dublin rate, and they have a Belfast rate. They match it in Belfast, and it slightly goes up in Dublin, but it's still not going up by the same extent. So I kind of wanted to skip to the end a bit, but basically, as the rates go up in London, they're not getting matched in Ireland. Initially, this is good for Ireland. Basically, they're running on low rates compared to Britain. It's fueling a boom. You have British banks borrowing in Dublin to clear debts in Britain. So it's a kind of a clearing trade going on. Turns into a shortage of punts in Ireland. So these are the different kind of main events, right? So the UK rate rises very sharply. This is one of the sharpest rises in about 100 years. It's really sharp rise, and the Irish rate doesn't match. So it's always lagging behind. And traditionally the view was, well, inflation is different in Britain, and that's why they did it. So that was the view of Honan, O'Grada and Meenan, that basically it's UK demand-driven inflation. But it's not really, because if you look at these figures, so this one is the inflation rate in the US, Ireland and Britain. So Britain's slightly higher, but it has been decreasing. And the rate rises are very sharp in Britain suddenly in 1955. So it's got more to do with the sterling crisis than the kind of inflationary conditions. So I'll just show you briefly what we did. So we got this data from the Dublin Stock Exchange. So Dublin Stock Exchange is one of the oldest in Europe. They had a direct phone line to the London Stock Exchange from the 1890s. So it's pretty much the same thing. So you get this data, it goes back to 1890s, and then get data from the FT and from London Stock Exchange. So we have basically Irish data, we've got British data, and we compare the two. So we have a lot of different things. For the Irish stuff, it's pretty much everything, but we focus on basically long-term bonds, so anything over 10 years. For Britain, we have everything, including war loans. And war loans are huge, right? So a lot of analysis takes the war loans out. You can't take the war loan out because it is basically British debt. So you have to think about, well, what's the best way to do it? So we have our gilts, but the war loan is very important for this. So long-term series here go back to the 1940s. So I had a discussion earlier about, well, there's always a premium. Sometimes there's not a premium, right? So sometimes the Irish one is below the British rate. And that's kind of surprising as well. So the console rate is always lower, but the UK rate, there's variation. So this is from 54 to 56. This is one I think is more interesting, and this is where we'll take the analysis further next iteration. But basically, it's showing us the Irish rate, the Irish yield on government debt, the yield on UK debt. So nothing's really happening with the Irish one. It is increasing, but the gap from 54 to 55 is shrinking because of an increase in the yield on British bonds, it's not purely driven by the increase in yield on Irish bonds. And it coincides with the drop in sterling. So sterling is falling, interest rates are rising in Britain. And then that's going to transfer to Ireland. So it's being driven from the sterling exchange. So that's kind of like the main, like everything else is just, what we do for this stuff here. But I want to get kind of closer to the end. I'll show you some, just if I go back briefly, this is our bank. We make a banking market cap for Ireland and compare it with the market cap for Britain. So what's happening? So some of the biggest banks here, some of the British banks own some of the banks in Northern Ireland, so they'll be part of this, but we try and make a distinction then between British banks, Irish banks, and use this as a proxy for what's happening to capital in Ireland, the capital flight from the island. So what we do is we compare the different banks in Ireland. How are they performing in terms of their note issue, the ones with note issue north and south, and the ones that only can issue notes in the south. Do various things for this. These are all the various assumptions we make. But we can compare all of Ireland with UK as well as just the subsample to make it kind of reassuring. But our main kind of finding from this kind of analysis, it's been driven by the banking sector. So the banking sector sees a fall in its market cap. And this is leading us to believe that it's monetary policy driving the shock, not fiscal policy. So it's kind of capital flight from Ireland through the banking system rather than fiscal policy. So we use some things to our advantage. Basically, it's the same area effectively. It's an optimal currency area. It's a unique place. They're very similar governments, etc., etc. And we do an event study to see, well, what's driving it? Do they match up with our known events, etc., etc., and do break tests. So what we found then was that the banks start investing in Britain for higher returns. They start increasing loans, and then this decreased their reserves in Ireland simultaneously. We see like this coincides with British monetary policy events. And we see some things that are kind of counterintuitive for us, but they kind of make sense in the broader scheme of things. One of the kind of interesting thing is like, well, what's happening to the banking sector? And within 10 days, 3% is wiped off the Irish banking sector's market cap. Right? So it's a big effect on the Irish banking sector, and this is just to show. So people are aware of what's happening, and there's basically been a slow capital flight from Ireland, and it's through the banking system. The two series are co-integrated, etc. I don't want to go into all that kind of details. The difference between the north-south, there is a difference between banks that only issue notes in the south and ones that operate island-wide. They find it easier for basically you can take a note from the south, bring it north, etc. It's easy enough to withdraw your money from the country. There is a distinction between Irish banks and UK banks, so it's only happening to Irish banks, it's not happening to UK banks. So it's distinctly Irish event affecting Irish banks. And when we look at the UK-Irish yield, so this is the government debt, we don't see that much of a differential. And this leads us to believe that it's mainly coming from the banking system. So the banking system is where the capital flight is coming from, where the balance of payment crisis is kind of being manifested, and it's not necessarily from increase in yields on government debt. So that's kind of like the main implication from all of this. So I'm conscious of time because I wanted to do a bit more just on the decision to leave sterling at the end. But basically, for this particular study, its expansionary monetary policy can only be maintained if you have the reserves. They had the reserves in 1952. They used the reserves up. The reserves were falling. By the time 1955 came about, there weren't enough reserves there to do this experiment. And then with capital flight, the experiment came to an end prematurely. So that's kind of all of this stuff. I think it's a really important event in Irish macroeconomic history. It's underappreciated. Basically, it sets the country up to a low corporation tax, etc. And I think it tells a lot about what's happening in Britain as well, because it's this sterling crisis, it's this continuation of sterling crises that lead to this stop-go in Britain. It's why Britain has a relative decline. I like this picture. It's just this is the new era, right? Because you got Leprechaun, but there's like factories. So it's this new spirit from Time magazine. And the last thing I want to just talk about, because I know I've gone over time, is just why do you break the peg? And this is where I think it's really interesting. So they break the peg March 1979. Why did they do it? So you've had the peg basically from 1826. But they realized that sterling is no longer a stable currency and it's no longer credible. People here probably don't remember, UK got a bailout from the IMF in 1976. It was a sterling crisis. It was trying to maintain the value of sterling. Ireland was importing inflation from Britain via sterling. And they decided to become part of the European project. Let's become more European. Let's embrace European exchange rate mechanism. Let's try different things. This is the punt to dollar and then pound to dollar exchange rate. And I put this in because there's library of mistakes. Well, who made the mistake? And what I think the biggest mistake, so the blue line is the IMF bailout, the red line is Ireland leaving. And at the time, people in Ireland said, we will appreciate against sterling. We will become uncompetitive against Britain. This is our biggest market. This is the worst thing we could do. This is the best thing that ever happened to Ireland. Depreciate against sterling, don't have to do anything, and all of a sudden you're more competitive against your neighbour. Your neighbour has become uncompetitive against the rest of Europe. Anyone know why sterling appreciated so rapidly in the late 1970s? Give you oil, yeah, it's a petrocurrency. So you leave a petrocurrency. In the economic literature, we talk about the Dutch disease. I don't think there's a Dutch disease. There's a British disease, and the British disease gets papered over by oil. Oil comes on stream. The British disease, people stop talking about it, but it's crowded out most of the UK manufacturing sector. The exchange rate is what kills UK industry. It's not Thatcher. It's the exchange rate. I did have one more slide, but sure, I can leave it there. So, yeah, sorry I went over.
Why don't you take a seat? There's a little bit of oil for you. That's just come out of the North Sea. So we have some oil here. Please take a seat. So we're going to talk about exchange rate policy and how it affects monetary policy. And obviously it is germane because Scotland may one day set up its own currency. The second biggest economy in the world has a currency policy, as you mentioned, which is China, and then Hong Kong. But let's start with the mechanism. Just explain in detail why the reserves are so important in a currency board system, and maybe a little bit about, I assume that Ireland's reserves come initially from a deal with Britain. When it leaves, it gets some reserves, and I expect they accumulated a lot of reserves during World War II, is that right, by running surpluses? And just explain the mechanism through which reserves go up and down in a currency board system, and then we'll talk about what that might mean for Scotland in a system like that.
Yeah, so we'll start with where the reserves came from. Basically, they came from 1920, or say 1919, there's no border. 1922, you put a border, but the banking system never changed. The banks in Ireland always got deposits from Irish farmers, effectively, and it got put into the London money market. When you put a border, that turns into foreign reserves. It's the reserves you hold overseas. They weren't given those reserves. They were the deposits of...
So the reserves were off the commercial banks, not off the central bank? Or
yeah, the central bank starts up slowly accumulating reserves over time from seniorage, from the notes. But at the start, it's the commercial banks.
So is that a weakness of the system? That when I think of the currency board system of Hong Kong, there's $403 billion US owned by this, let's call it the central bank currency board. But Ireland never had that with these reserves of commercial banks. How does that complicate things for the...
I don't think it does complicate. Like, this is why I was talking to so Ronald McDonald, he was anti like independence. I don't see a problem with independence because like from 1920 to 1927 there was no currency board. There was nothing. Currency was never an issue because the banks continued to operate like they always did. They had free capital mobility and they could use the London money market just as they always did. So they never had any. So this is the really nice thing. You can operate as long as you have this kind of fixed exchange rate.
The downside is you have to accept English interest rates, right?
You have to accept English interest rates, and you should probably be slightly above the rates. So you sacrifice your independent monetary policy. But they had done that for like 100 years before that.
This was a different era when fiscal spending was a bit more constrained and the expectations from the fiscal side was a bit more limited than it is today. How would this work in a modern world where we have a much more interventionist government in social spending, health spending, et cetera, et cetera?
Yeah, that's a good point. So like when Ireland became independent, it inherited like a huge welfare budget, and this became problematic. Like how can you maintain that? So you're right, like in an era like this, government's share of GDP is probably about 5 to 10%. You'd have to rein in government spending. So this would be a problem for like a situation like Scotland. You'd have to rein in government spending if you're going to do something like this.
You've covered two currency systems here, because one's a currency board system, but then the United Kingdom is not linked by a currency board system to Bretton Woods. Give us your recommendation for Scotland. Which is the best way to do it? And what's the downside and upside of this currency board system for any independent country, whether it's Scotland or anybody else?
So I think the currency board gives you some flexibility, more so like if you're operating a flexible exchange rate, you don't need this interventionist policies. But if you have a currency board, it gives you the flexibility to adapt with the times, because times change. One system might be the best for a particular period of time, then the time changes. And if you don't have the flexibility in your system, you find it very hard to adapt.
So I lived and worked in a currency board system, which was Hong Kong. Sometimes what is different about them is you have to deflate sometimes. And I personally deflated. I had to take a pay cut, as did most people in Hong Kong. I think wages fell 15%, property prices fell 50%. There's nothing you can do from a monetary perspective about that. Do you think the modern era in a democracy such as Ireland or Scotland, you could kind of live with the volatility that comes with this sort of monetary policy, following somebody else's interest rates, not really having your own?
So I didn't talk about this, but 1920s and 30s is obviously the really interesting one for the deflation. Like when after World War I, when Britain goes back on a gold standard, goes on a really high level, and they have to impose deflation. And Ireland gets this deflation by default. It's not popular, and this is probably what brings in change of government, general sense of the time. But it's something that it's not tolerated as much. Whereas same thing happened with the euro, right? So Ireland had deflation pretty much for the 2010s. Remember I was teaching classes and it was like classes about inflation, but we had negative inflation, we had deflation. And then trying to explain why inflation, when you're in a deflationary world. But it came from the euro, like that was the euro policy. Sure. And this is what, basically country went through in the 2010s.
I read the paper, and you mentioned tonight, I didn't know whether you were being sort of comical or not, saying the policy of the Irish government was to reduce the population. That's not serious, is it? They didn't write papers saying, if only we could reduce the population.
No, that's a joke.
That's a joke, yeah. I thought so. Yes. But they certainly did reduce the population, and you attribute it partially to the monetary policy in place.
Yeah, look, it can have a devastating impact, like basically shrinking economy. Less opportunity. But this is the benefit of a flexibility within the system, because you can migrate. From a central banker's perspective, right? That's what they say. They like flexibility in the system because the more people are willing to migrate, and there's been a history of migration, so people leave. And if there was no migration, things would get even worse.
Yeah, I'm thinking of Greece actually, because obviously Greece out of the crisis didn't have monetary flexibility inside the euro. And people will know that the fertility rates around the world are collapsing, but not like they're collapsing in Greece. And that's because all the young people had to leave. So that monetary experiment of the euro and the economic consequences will have consequences on the population of Greece for 60, 70 years. And it had implications on the Irish population for, it was a long time before, I think it was only 1964, the Irish population starts to rise again.
Yeah, so it has implication for long-term planning as well, because if you're basing decisions for the next 50 years on a falling population, this is what happened with Ireland recently, that the planning that was done in the 60s and 70s was declining population. You make decisions on investment and infrastructure based on that. You're not ready for when it does increase.
Yeah, so we should talk about China, because it's not a currency board system. It's a bit more like what Britain was trying to do in the Bretton Woods. It's got this basket, it tries to manage against a basket. Over there we have an award which we presented to the Central Bank of China, or Mistake of the Year award, because they decided that they wanted to beat the trilemma. And what they were going to do is just buy lots of domestic government bonds anyway, even though they had capital flows, they don't work properly. And that had to be abandoned within 6 months because it failed. You imply that this stuff wasn't even understood until 1964. What is it about governments that they don't understand that you understand? What is it that we still have to go through some of these experiments without people really ultimately knowing the consequences? There's been a few others as well. Yeah,
so China is obviously, I don't know what books they're reading, but they're obviously... No, because it's mercantilist, right? So this is a different mentality, a different view of the world. And in a mercantilist world, all bets are off. But for China's response to the current trade war, one of them was the devaluation. Like they devalued in 2016, was it? Like that's their response. So they're, I don't know. Like China's just taking a different view of the world, different trajectory. How they see things. It's different to what we would advise governments to do in terms of trying to optimal currency area, etc.
So one final kind of question for me. Britain, everybody in the Bretton Woods Agreement has capital controls, but there's no capital controls between Ireland and Britain in this, which makes things pretty complicated given that everybody else is running them. But Ireland's one of the few countries in the world really with an open capital account in this period? Yeah,
pretty much. That's what makes it a nice experiment, because capital flows so freely between the two countries. And within the island of Ireland, basically you have a small border. Sure. And you have the same banks operate either side of the border.
Well, there's not much you can stop crossing the border at Monaghan, whether it's pigs or money. So hopefully we put it in a context as to why this is potentially important, not just for Scotland, but actually what's developing today in China and also in Hong Kong, and that will affect all of us. Do we have any questions from the audience on currency systems? I think you're quite happy to go beyond currency boards and talk about currency pegs, independent monetary policy. Any questions?
So, if I've understood your argument correctly, the situation you describe in Ireland is you have a lot of deposits from farmers, basically, and the assets of the Irish banking system are largely in UK government securities, which act as the reserves of the system, which then allows an independent Ireland to run a balance of payments deficit for many, many years. Those reserves help that to clear. Now, isn't the situation in Scotland, or the potential situation for independent Scotland, isn't it very different? Because the assets of the Scottish banking system would not largely be in UK government securities. The assets would be loans and mortgages to the Scottish private sector. That makes quite a big difference, doesn't it?
So you mean like the overseas assets? If Scotland became independent today, where would the overseas assets be?
Basically my question is, Ireland had reserves or reserve-like assets that allowed it to run a balance of payments. Scotland would definitely have a big balance of payments deficit, largely with the UK on the other side of it, but it wouldn't have those reserves to get away with it. Is that correct?
Yeah, no, I see where you're coming from. So, like, the main issue with the Scottish banking system would be where are the external reserves? Do they have any? Would they have any? And that's where the current UK banking system is more complicated than it would have been back then. Like, literally separated by an island, whereas now you have UK banks. Like, I'm banking with TSB. That's a UK bank, right? So what's that going to be split in half, or where would the assets be? Like, what assets? So it's complicated. Would it have assets in London after independence? It might do if it has English loans, not just Scottish loans. Like, where are the deposits from Scottish banks going? Are they all just being reinvested in Scotland, or are some going to England? I don't have the answers off the top of my head, but that is the equivalent. Like, there were not just government debt, that was just the model at the time, that was the model of all banks at the time. But today, yeah, it's a national market, right? So it would be, some element of the portfolio will be domestic, some will be international, just because it's in England. Would that be enough? I don't know.
So, I mean, what it does suggest is if it happens, actually how you divide up commercial banks would be crucially important, and where their assets and liabilities would be important. The United Kingdom has national reserves, so Scotland would negotiate to get its portion of those reserves, presumably get them in the negotiation, as long as they accepted their proportion of the debt. So we don't know, but the point is that working out where those reserves are would be absolutely crucial in terms of the stability of this. And if you don't have large reserves, you're going to have stop-go. You're going to have constant crises. So negotiating the scale of the reserves would be an exceptionally important thing for independent Scotland. Is that one of the conclusions from it?
Yeah, I think that would be definitely one of the conclusions. The negotiations over the debt are also, like, really important. I don't know how Ireland managed it, but they came away with no debt. One of the things they gave up, though, was territory in Northern Ireland. The boundary of what they thought Northern Ireland would be was a quid pro quo for not getting debt. Would there be something Scotland? I wrote something years ago. It's kind of flippant, but it was like, well, you could take the nukes. Right? How's Trident? Stuff like that. Because that is kind of not what people want.
It doesn't sound like a friendly negotiation.
No. Yeah, it was. Well, it's like what leverage?
Sure.
Have, right? Like, it's not going to be take. It's negotiation.
Yeah, I was just thinking about what you said about Northern Ireland and the debt, and if that was a pact. I mean, one of the reasons that New York is the financial capital of America is a deal on debt as well, which was put together by Alexander Hamilton to unify all the debts of the states. And in return, Washington D.C. became the political capital. So the history of debt has, not just impacts on economic growth; it's got impacts on society and Trident, maybe. Defence. Do we have any other questions on, yes, this gentleman right down the front here? If you mind just waiting, because we're recording it. And, oh, sorry, you're next.
Oh, sorry.
No.
It feels like the sort of ultimate solution was sort of jurisdictional arbitrage by bringing in the low corporation tax. How important would it be for Scotland to basically leverage jurisdictional arbitrage against the rest of the UK to basically make up for, let's say, a lack of reserves, or taking on debt that would be quite difficult to service and so on?
So do you mean like have a lower corporation tax in Scotland to get vis-a-vis the rest of the UK?
Yeah, I mean, the idea is that I think the corporation tax is one of the reasons that exports went up, one of the reasons that balances were built, one of the reasons that it wasn't stop-go. Is that the future for Scotland? That would have to do something similar?
It wouldn't necessarily need to be, let's say, corporation tax, but like just something else that would be advantageous to people investing in Scotland, I guess. That would make it more attractive over doing something in England, let's say.
Yeah, so to answer that, there's a really interesting paper I saw last week. It was Irish Economic Association, and it was Frank Barry. And it seemed like a trivial question. Who had higher FDI, Northern Ireland or Republic of Ireland before the they joined at the same time. South is a lower corporation tax. On paper, it looked like it was the South. But then the question was, well, what is FDI? And for Ireland, it was including investment from British firms, from England and Scotland, investing in Ireland. For Northern Ireland, that is not, that's what they're getting, but that's not considered as FDI. So both attracting, they both want to get firms from Britain to invest. Okay, change the calculation to be what's not Irish investment. Northern Irish FDI was much higher than the South, and was more successful at getting American FDI, even though it didn't have this low corporation tax. So I'm not sure, or something else happened in Northern Ireland, I don't know what, after that, that maybe kind of discouraged FDI. Like they did get, what's it, DeLorean.
We have had a whole session in here on DeLorean once, actually, in the old Library of Mistakes. There's some great papers on that by Professor Graham Brownlow in Belfast. I think we have one final question. And
picking up on another aspect of arbitrage. So this premium of UK gilts over Irish government bonds was so consistent. The Irish government bonds had to pay a higher rate for the reasons you explained very lucidly than UK gilts. So if anyone, I don't know if anyone was doing this analysis in the 50s, an Irish George Soros, but there was obvious, it seems to me, arbitrage opportunity that once the yield gap, the yield premium disappeared and British bonds now are paying a higher rate, or the more lowly price than the Irish bonds, you'd simply buy British bonds and sell Irish bonds at the equivalent duration. And the other thing, leading from that, because I'm always interested, not so much in history, but how can is there an arbitrage opportunity today? Would I be right in describing the euro as a currency board with, I can't remember the word you used, but the dominant player there is Germany. So effectively Ireland, having been part of the UK monetary system, is instead now part of a German monetary system. And obviously you're locked in, everyone in the euro is locked in at that rate. So if you did the equivalent analysis that you've done, if someone with computer technology and worked out, for example, Greece must always have a premium of such and such over Germany and a lesser premium over, let's say, France. If those premia got reversed in some extraordinary situation, could there be an arbitrage opportunity there as well? And just say, right, it's time to buy German bonds, just as in 1955-56, time to buy British bonds and sell Irish bonds. But that's my question. The question is, was anyone, I'm not sure that anyone's doing this analysis in the 50s of this type, not in Dublin, because if there had been, surely some equivalent of George Soros would have said, let's be sure to keep our bets manageable, but it's time to bet against Irish bonds and in favour of British bonds, because there's no way Irish bonds should be commanding a lower yield than British bonds in the mid-50s.
Yeah, I haven't come across anyone doing that type of analysis for the 50s, but for the present day, I did look at this recently. Greek yields have gone down significantly. They're close to German at the moment. So if you're right about arbitrage, now's the time to buy German bonds, right? For the 1950s, I guess, because the Irish banks would have held the a lion's share of the Irish government bonds. So they should have been the ones doing this. If anyone's going to do the arbitrage, it would be them. There
is the issue of regulation as well, and what Irish banks are asked to, I better have that microphone, what Irish banks are told to hold under regulation, what Irish life companies are told to have under regulation. So behind this, there are limits to arbitrage in forms of regulation. We didn't have hedge funds in those days either. But the trade you're talking about, every hedge fund in the world is trying to do that trade and make money out of it. And probably the most spectacular casualty was something called long-term capital management, which was doing exactly that with huge amounts of leverage and got it wrong. So it's, that's been a trade that's been around for a long time and can be potentially dangerous if it has lots of leverage in it. But I would have thought the regulation of both banks, British and life insurance companies, would have had some restrictions on the ability to do this arbitrage. We are going to stop there in terms of questions, but there is alcohol. And Eoin will be here to answer questions. Alcohol comes courtesy of our friends at Kennox Asset Management. I hope you'll hang around and join in the conversation as ever after the lecture. But at this stage, would you please, in the normal way, thank Eoin. I bought those from a guy in the Highlands. He had worked. What happens if you were an engineer?